Welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Chakri Lokapriya, MD and CIO at TCG Asset Management, joining in. Welcome to the show, Chakri, and always a pleasure to speak to you and get insights from you. Chakri, overall, let's start with what's happening with global markets across on the back of the geopolitical crisis that we have been looking at right now. How are you reading the entire situation? Because clearly there is a lull coming in with regards to where the equity markets go, a major sell-off, whereas there is good buying happening in terms of the commodity side of it.
Good afternoon, Hiral. Thanks for having me. Yes, it's been quite an exciting period for the markets, to say the least. But on the negative side, the markets have fallen. Nifty is down about 10% in the last few sessions. And on a year-to-date basis, the mid-cap index has fallen close to about 7-8%. Nifty has fallen about 3 or 4%. Now, why is it all happening? Is because if you look at the U.S.-Ukraine conflict right now, it's all about oil and commodities. Now, India is a big importer of oil and commodities, and therefore higher oil prices indirectly causes inflation in India, which we'll discuss about.
Right. So overall, if you go to see, for a country like India, what is the major risk we should be looking at right now?
If you look at India's import bill, a good 30-40% of the overall import bill is because of oil and oil-related products. And the good news is, our forex reserves, India's forex reserves are very high right now. So it's in a far stronger position than it was, let's say, 5 or 10 years ago. On the other side, today oil prices have reached a high of 8-year high. Last was probably 2013-14. So the net impact of that is higher, because today BPCL, HPCL are all price pass-through. So it translates into higher petrol, diesel prices, translating into higher freight costs, transportation costs, and packaging costs, and across all board. The government has not, I guess, the BPCL and HPCLs have not passed through these oil prices yet. And if these prices sustain, I think some amount of price hikes will translate into higher inflation and therefore, kind of eat into growth.
Right. So basis this, when we translate that clearly there would be a pass-through if we see prices go further. And assuming your HPCLs, BPCLs, IOCs of the world go ahead and pass on the price hike, what would your recommendation be from a company perspective? Would you advise to buy these companies, or would you ask to wait and watch yet?
That's a good question. If we step back and look at the overall market, still India is in a recovery mode. Business and earnings has not yet reached pre-pandemic levels. And just the third wave is getting over, and earnings recovery. If you look at Nifty's earnings for FY22, 23, and 24, FY23, we are talking about only a 5% growth in Nifty earnings. Now, that's a very low level of growth, to much below the trend line. If you look at India's inflation rate, it's about 4-5%. So which means companies are not growing much higher than inflation. In other words, their growth is not yet recovered. Now, that is the good news, because, all the stimulus which was provided, the PLI schemes and the other budget initiatives are yet to translate into growth for companies as we go into FY23. So from that perspective, Nifty is not overheated, and therefore the corrections in individual sectors won't be much beyond the damage we've already suffered. So having said that, now there are beneficiaries, and those will get impacted. So the beneficiaries would be all those imports. IT, rupee will depreciate, they will benefit. Metal companies will benefit because of the supply chain disruptions that will happen in Russia. And then chemical companies will benefit because, exports will increase from India. And, some of the auto component companies in the EV space will benefit.
Right. And, when you made this point as well in terms of where Indian markets are go? Is it right to say that currently they are still undervalued? There is good room for recovery that we are yet to watch out for, and probably this then could be the best time to start nibbling in.
Indian markets, you're right, are absolutely undervalued because we just spoke about earnings just now. If you look at multiples, the Nifty multiples are trading at 18 times FY23 and probably 15, 16 times FY24, which is very much in below trend line of what the peak multiples that India has traded at 23 times, 24 times. This is if you rewind back to 2007. At that time, mind you, the Nifty earnings were growing at 35% plus, and the PE multiple was 23 times plus. So you could say that on a peak multiple, peak earnings, you had a peak multiple. Now you have the opposite situation on very depressed earnings of about, let's say, 10, 11% for FY24. It's trading at only 16 times. So which means as earnings accelerate, the multiple will look cheaper and cheaper, which provides the room for further growth as this current crisis kind of eases out and oil prices come back down from the $100 mark to about the $70, $80 mark.
Right. And overall, in terms of companies that could benefit out of this as well, you've mentioned a couple of sectors, but anything specific apart from, IT or any of the chemical companies are concerned that import substitutions will benefit?
Now, IT companies, one, I think it's worth reiterating that will clearly benefit, and also important from an Indian perspective because they bring in a good amount of export revenue. So they bring in dollars into the country, which is very vital at the time when the import bill is going up and there is an outflow of dollars because of high oil prices. So that kind of offset provides a cushion. The IT provides a cushion. The same way, I think, the metal companies, again, it's not just metal, but a lot of for example, even the fertilizer companies will benefit. The irrigation composite companies like Finalex Industries, these companies, they will enjoy petrochemical companies. They will enjoy increased spreads because, prices of oil and oil-related products going up. They have an existing inventory as well as demand spread. They'll enjoy pricing power. And so the numerous sectors, and of course, pharma will continue to benefit because a good chunk of their revenue is export-related revenue, and that will also benefit. And all these will provide buffers to the Nifty's overall earnings.
Right. And overall, if you see in terms of this kind of a falling market, if you have to see, what would the sectors, first let's start with that, would you actually pick on?
The one thing is banking as a sector has underperformed over the last 1 year or so. In fact, over the nearly last 2 years, you can say that. And largely because even there was a lack of credit growth. And that is natural because if the whole economy is locked down, the economic activity is low, therefore the demand for credit is low. Now, as unlocks are happening, the opposite will happen, which is as companies and small businesses and individuals begin their activity, credit growth picks up. And as credit growth picks up, and therefore banks benefit. Banks also will benefit with certain amount of increased spreads. Now, the only spoiled sport of the whole that is now this Ukraine crisis is a new angle. Because of that, it creates higher than expected inflation, translating into lack of pricing power. Whether companies will be able to pass on is a question that will hold back some of the banking sector's gain as well, because credit growth might be slightly lower, but overall the trend is positive.
Right. And coming to, companies which could have a negative impact in terms of rising costs, especially when you talk about consumer discretionary, you talk about FMCG, what would your advice be? Because clearly a lot of packaging companies have higher raw material costs, which are dependent on rising crude prices. Paint companies are the ones which again have a lot of dependency in terms of crude prices. How would you advise an investor to look at both these sectors, given the current situation and taking into account the earnings that have already come in so far basis valuations?
That's a very good point, Hiral, because if you look at FMCG companies, if you take any, take a surf, take any of those products, packaging represents like a good 15-20% of the cost. And they're all actually petrochemical oil derived products, which go into the packaging of product, which now will have higher raw material cost. Therefore, FMCG companies will have to pass it through. They may not pass it through because the consumer is not really strong. So because of that, if they don't pass it on, it translates into lower margins for FMCG companies. And mind you, if you look at FMCG companies today, they're already trading at high multiples. You like even the best of breed companies, Hindustan Lever, Nestle, they're all trading at 50, 60 times PE. Of course, they're high ROE businesses, that's another thing. But will they further benefit? No, the answer is therefore, in an uncertain market, people usually go towards FMCG. But in this case, I would advise not to go to FMCG because it's not going to provide any kind of upside. And the same thing holds for paint companies. Paint companies have been passing on the oil prices increases. Their raw materials are oil dependent, but they passed on a good 20%. Now, will they have room for more? It's highly unlikely. So again, they've done well. So again, stay away from paints as well. Stick with more towards the IT, or even stick with chemical companies because they have the pricing power.
Right. And overall, if you see in terms of the budget announcements as well, clearly it was an investment heavy, capex heavy budget. Not really much, that came in from the demand side as well. So basis the budget that was announced, would you still be positive in terms of infrastructure as a sector?
It was an extremely sensible budget, very realistic. And if you look at the thrust on infrastructure, and those numbers are now pretty much are in line with the pre-pandemic numbers. So which means it kind of assumes that private capex will grow at about 12% odd. Government capex will grow probably about 12-15%. Now, government capex is basically roads, power, utilities, etc. Private capex is just expanding business activity. Now, private capex will happen a bit later simply because capacity utilizations are still in the 60-70%. So which means private companies will still first look to fill up the capacity utilization, reaching that 80-85% before they do new capex. On the other hand, the government companies, roads, bridges, and now EVs, and the infrastructure work related towards green technology, whether it's green hydrogen, whether it is infrastructure, setting up networks, all this, clearly are not really secular growth, new sources of growth, but that's something which will support and as well as reduce the dependence on oil over the longer term.
Right. And overall, if you see in terms of where, the markets are concerned right now, a lot of IPOs that have come in. The next one that everyone, Chakri, is watching out for is with regards to LIC. What's the sense that you have with regards to LIC?
LIC clearly, it will be a blockbuster in terms of the size of the IPO done. And hopefully the pricing will be, the good news is actually that post this correction, a lot of the multiples have moved down. So which means the multiples at which the IPO is likely to be priced is going to be hopefully far more realistic and therefore providing upside to the individual stakeholders, which is both the LIC policyholders, the retail investors, as well as, of course, the institutional investors who will participate. LIC, clearly is one of the biggest equity players in the Indian stock market, and they have a higher equity exposure translating into a higher multiple at which the IPO can be priced. So depending upon the multiple at which finally the IPO is priced, I think LIC's IPO should see strong demand.
Right. And overall, Chakri, if you have to look at levels in terms of Nifty as well right now, we know there have been multiple corrections that have happened due to the geopolitical crisis. But what would it be as a fair value to assign to Nifty right now? And secondly, what's the kind of upside that you're looking at in the next, say, 3 to 6 months?
Given the fact that we've corrected now, and the good news is still interest rates are still low. Inflation actually in India is largely supply chain related. So which means there is no real big rush, as the RBI has said, to increase interest rates. It's partly connected with the US. US is expecting a 50 basis point hike in the Fed when they meet in March. Now, that was, of course, pre-Ukraine crisis. So maybe the Fed will change its mind and do a 25 basis point. But if that happens, that's a big positive. If 50 basis point hike happens, no negative surprise already there in the market. And therefore, the spread between the real rates between India and the US remain intact, even without interest rate hike in India. So which means I think it's safe to assume that Indian market unlikely to raise rates in the next meeting or so. And so that will provide a kind of a support, allow time for companies to recover. And over the next few months, as the Ukraine crisis stabilizes, oil prices come back down from that 90-100 to the pre-Ukraine price, which was about the $80 mark. I think then the recovery is in place. And so going to your question of, because earnings are still depressed, if you factor in a roughly 12 to 15% growth in earnings of Nifty over the next 3 to 4 years, I would actually be tempted to say that the Nifty will be a good 60 to 80% higher 3 to 4 years later than where it is today.
Right. So everything said and done, Chakri, 3 to 4 stocks that you would say are best bets from a long-term perspective right now.
Look at very domestic companies which have no dependencies on external factors. If you take a large company like Larsen and Toubro, depends upon Indian infrastructure growth, trades at about 13, 14 times, will do well. Deepak Fertilizers and Petrochemicals is a fertilizer company, also transforming itself into a petrochemical company, trades at about 7-8 times. Growth is going to be north of 30-40%. Earnings growth over the next 3 or 4 years is a good mid-cap company. You look at a company like Quest Corp, staffing company. Companies are reluctant to hire, are happy to outsource hiring requirements. Company has corrected recently, a good like 30-odd% because of some management changes. The management has also appointed a new CEO. The new CEO is going to be around for the next 3 years, at least his contract is for the next 3 years. So bring stability. It's trading at very attractive valuations, growth story. So like this, there are numerous examples which will do well. And I think the market has enough number of stocks to pick.
Absolutely. So these are few sectors and stocks one should be looking at and probably take this opportunity to enter the markets as well. Thank you, Chakri, so much for joining us on the show. Always a pleasure to take insights and recommendations from you. Stay safe and speak to you soon again.
Thank you so much, Shara.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.